Ever since the financial meltdown in 2008, there's been a widening economic gap between the US and the European Union. Back in 2008, both the EU and the US were pretty much neck and neck when it came to their economies. Fast forward to now, and the US has sprinted ahead, boasting an economy that's a whopping $8.6 trillion beefier than the EU's. When you break it down to dollars per person, the US is cruising at more than double the speed of the EU. With many places in Europe seeing fewer babies being born, meaning their populations are getting smaller, this big difference in economic muscle looks set to only get bigger. For over 10 years, Europe's economy has been kinda stuck in the mud, not really going anywhere, while other parts of the world have been booming. 15 years back, Europe was riding high, with its economy outpacing the US by $1.5 trillion. But the tables have turned since the early 90s, with the US overtaking the EU and never looking back. Now, the US economy is looking pretty robust, hitting a stride with super low unemployment rates and making significant strides in the battle against inflation. Across the pond, though, the vibe in Europe isn't quite as upbeat. Germany, often seen as Europe's economic powerhouse, might just be in a recession, with inflation stubbornly sticking around. This shift isn't just a blip on the radar for the EU, it's part of a larger story that's seen the continent make huge strides forward in the past. But what we're seeing now might not be a crisis in the making but a slide into what could become a long-term slowdown. There are folks who'll tell you comparing the US and EU economies isn't all that useful, pointing out that GDP figures can swing wildly with exchange rates. Plus, they'll say, America and Europe march to the beat of different drums, with Europe's slightly less flashy economic figures reflecting deliberate choices to foster a better balance between work and life, alongside social security systems designed to look after everyone. Indeed, life in Europe tends to be less hectic and more laid back compared to other places. Plus, the healthcare systems across Europe, known for their almost universal reach, are often seen as better. These points hold water, but only to a certain extent. If Europe can't kick its economy out of the slow lane, these benefits might start to erode. So, why does this gap exist between two of the world's wealthiest regions, with the US economy speeding ahead at about twice the rate of Europe's over the last few decades? Well, Europe's economic landscape is a patchwork of nations. Some are at the cutting edge of competition, brimming with innovation and productivity, while others are still playing catch-up. This means the European Union isn't a monolith when it comes to economic health, there's a mix of speeds and successes across its member states. Looking at the past 20 years, a clear pattern emerges: the Central and Eastern European countries that have joined the EU have seen quick economic growth. Meanwhile, many of the continent's core economies have been moving at a snail's pace. The economic performance of the euro area, when matched against the US, has been underwhelming. Since the 1980s, this region has been playing catch-up with the US, leading to a noticeable dip in the EU's economic achievements. Several deep-rooted reasons help explain why growth rates in Europe have struggled to keep pace. But, if we set aside GDP and living standards for a moment, we uncover a more critical underlying issue: productivity. Productivity stands at the heart of wealth, development, and societal well-being. Historically, the US has seen its productivity rise more swiftly than Europe's. Digging into the elements that drive productivity growth unveils some intriguing trends in how economies behave. Over the last 2 decades, a key factor behind Europe's productivity boost has been the increase in capital per worker, also known as capital deepening. Yet, when we look at total factor productivity, TFP, growth in the EU, a measure reflecting the economy's tech and innovation progress, it showed more vigor in the 1990s before experiencing a downturn. Interestingly, the dip in Europe's productivity momentum doesn't seem tied to major structural changes in the economy, such as the growing dominance of the service sector in Europe's total production. Actually, these changes seem to have positively influenced the job market structure, contributing to an uptick in productivity levels. The root of the productivity decline is found within specific sectors rather than across them, with the manufacturing sector being a prime example. Here, a slowdown in productivity has been seen across businesses of all sizes and throughout the entire range of productivity levels. For any economy to grow steadily over time, increasing productivity is essential. This boost often comes from a faster rate of research, technology advancements, innovation, and investment. Essentially, it's about how individuals, businesses, and markets are embracing new technologies and business models to fuel economic expansion. Currently, the Eurozone records the lowest public investment rates, as a percentage of GDP, compared to any other developed economy or economic group. When examining the investment rates of Europe's largest economies, the UK ranks at the bottom. This investment shortfall can be traced back to the severe austerity measures European governments applied to their economies after the global financial crisis of 2008. Austerity measures not only harm those in society who rely on government support during hard times but also put a damper on investment opportunities. In any given economy, the total spent by everyone equals the total earned. When European governments cut back on public spending while private spending was also on the decline, they accelerated the decrease in overall income. There's a noticeable lack of spending in Europe. Since 2008, EU private consumption has been on a downward trend, hitting its lowest point recently. In contrast, private consumption in the US is on the rise, reaching record levels. An uptick in private consumption indicates that households and individuals have more money to spend and are feeling optimistic about their financial futures. This optimism translates into greater demand for goods and services, fueling economic growth. However, Europe's weak spending habits and challenging demographic outlook are making it a less appealing market for companies. From consumer goods giant Unilever to luxury behemoth LVMH, businesses are finding a growing portion of their revenue coming from North America, where consumer spending is stronger. The US consumer is more resilient than in Europe. Is it surprising that European companies hesitated to expand their production capabilities for products consumers couldn't afford? This is the stark reality of how the austerity measures post-2008 crushed investment across the continent, and steered Europe towards a prolonged downturn. In Europe, the investment in manufacturing green technologies is disappointingly low. Europe is lagging behind in areas like batteries, artificial intelligence, and other digital technologies that are propelling global growth forward. Consider the semiconductor industry. In 1990, Europe produced 44% of the world's semiconductors. Today, that figure has plummeted to just 9%, with the US slightly ahead at 12% and China leading the pack at 15%. The bottom line is that the US is outpacing Europe in every category of groundbreaking technology, the kind of technology that carves new paths for economic progress. The US secures more patents in computing and air than Europe, a testament to its strong footing in these fields, thanks to hefty investments in research and development, R&D, compared to the EU. Research indicates a notable disparity in both the investment in R&D at the corporate level and the outcomes, such as corporate profitability. A study by the McKinsey Global Institute highlights that between 2014 and 2019, European companies grew 40% slower than their American counterparts and allocated 40% less to R&D. Yet, Europe maintains its edge in materials technology and cleantech, areas where it has traditionally excelled and surpassed the US, still leading China in most technological domains within these categories. However, China and other Asian nations are embracing digitalization and new technologies at such a swift pace that they might outstrip Europe in the technological race over the next few decades. And then there's the realm where the US reigns supreme: corporate influence. Tech behemoths like Apple, Google, Alphabet Incorporated, and Amazon exemplify this dominance. These companies not only rule their markets but also wield immense global influence, driving technological innovation and shaping consumer trends worldwide. Their significant economic power enables them to pour substantial resources into research and development, fueling progress in fields such as artificial intelligence, cloud computing, and e-commerce. Looking at any global corporate ranking, be it the top 50, 500, 100, or 20, American companies are consistently at the forefront. China holds the second spot, while European firms, which 2 or 3 decades ago would have been prominently represented by industrial giants like Fiat, Mercedes-Benz, BMW, and Philips, have seen their positions in the rankings decline. Currently, Europe finds itself with only a handful of key players on the global stage, lacking any major presence in the platform sector and boasting just 2 tech giants, ASML, a Dutch lithography company, and SAP, a German software corporation. Europe's challenges are not new. With an aging population and a greater emphasis on leisure and job security over higher wages, the continent has experienced sluggish economic and productivity growth. Moreover, the COVID-19 pandemic and the ongoing conflict in Ukraine due to Russia's actions have compounded Europe's difficulties. In this context, the US enjoys certain inherent benefits, including its status as the world's leading producer of fossil fuels, in contrast to Europe's position as a major consumer. The surge in energy costs, significantly steeper in Europe following Russia's invasion, is straining both the economy and its citizens. The EU stands as the globe's second-largest economy and, crucially, its biggest trader of goods and services. Historically, Europe's robust export sector has provided a cushion during tough times. However, while exports can be both a strength and a vulnerability, a critical aspect of trade prowess is the degree of reliance on foreign markets. The more a country depends on trade, the more vulnerable it becomes. Europe's deep dependence on exports, which make up around 50% of the Eurozone's GDP compared to just 10% for the US, is increasingly becoming a liability. Diminished global demand and a slow rebound in China, a key market for Europe, are eroding this foundation of growth. Sky-high energy prices and surging inflation, unseen since the 1970s, are erasing the competitive edge European manufacturers once enjoyed in global markets. This isn't to overlook the fact that Europe's economic growth has been lackluster over the past 15 years. Following the Eurozone crisis that began around 2009 to 2010, policy missteps were made, leading to years of economic underinvestment exacerbated by austerity measures from 2012 onwards. These challenges are set to limit Europe's prospects across various fronts, including economic growth, inclusiveness, sustainability, and its capacity to assert itself strategically on the global stage. Yet, Europe has the potential to leverage its strengths. Its socio-economic framework has historically proven effective. When Europe's system functions as intended, it excels. Europe shines in sustainability, emitting 2.4 times less CO2 per person and 1.8 times less CO2 for every dollar of GDP than the United States. In terms of inclusion, Europe is at the forefront, excelling in areas like equality, social progress, and overall happiness. With a Gini index of 29.6, which indicates low income inequality, and has been on a downward trend since 2014, Europe stands in stark contrast to the United States, where the Gini index is 41. Regarding social mobility, Europe dominates, hosting all top 10 nations in the World Economic Forum's Social Mobility Index. Moreover, Europe boasts the highest average life expectancy globally, at 80.3 years, outpacing the United States and China, where life expectancies are 79 and 77 years, respectively. Europe has consistently been a leader in fostering sustainability and promoting inclusion. Concerns are now heightened regarding the security of supply chains, including energy, food, and defense. The question arises, how much attention should also be given to the widening corporate and technology gap threatening future growth and strategic independence, and when is the right time to act? Could the united response to the war in Ukraine serve as a catalyst for embracing the necessary compromises for technology advancement and competitiveness, which have previously seemed too challenging? Policymakers must likely intensify their efforts to enhance the business and innovation landscape in Europe. This involves a detailed examination of various technologies and industries to fortify Europe's approach, ensuring it is robust and sustainable over the long haul. Essentially, it's about identifying and reinforcing the weak links to maintain Europe's competitive edge in the realms of business and technology.